Hello, everyone. Thank you for joining me today for Sentinel Net Lease's U.S. Economic and Real Estate State of the Market webinar. I'm your host today. My name is Dennis Cisterna. I'm the co-founder and chief investment officer of Sentinel Net Lease. I've done about $4 billion worth of real estate transactions throughout my career. And I started my career as a housing market and economic analyst, former host of the Investability podcast, as well as a monthly contributor for U.S. News and World Report, as well as Builder and Developer magazine. Going to spend the next 30 to 35 minutes walking you through what's going on with the U.S. economy and how that specifically relates to the commercial real estate universe and what we're seeing in various sectors across the CRE landscape as well. And then we're going to finish up with just a brief overview of our latest offering, which is Sentinel Opportunity Fund 1. Without further ado, I'll jump right into it. Looking at the economy, I think before we worry about too much what's happened in the past and what's going to go on in the future, we need to take a moment to just reflect on where we are today across a variety of key metrics for the economy. And so we're going to start out with the stock market here. It's been obviously red hot as of late. Over the past year, the S&P 500 is up 32% in change. That's an all-time high. Our GDP growth, that's the economic output growth of the U.S., is up 3.2%. That's 23% higher than where we were at a year ago. For those of you that are following what the Federal Reserve is trying to do to slow down inflation, they're having a real hard time getting this all under control through just interest rate increases. And we'll talk about that a little later. But looking at another element, really the core element that the Fed is focused on right now is slowing that inflation rate. You can see as of right now, the annual inflation rate is slowed to 3.2%, which is a pretty significant decrease from where we were a year ago of 6.4%, but it's still extremely high. It's not where we need to be. It's not where the Fed's target is of under 2%. And more importantly, because we had such crazy inflation for a few years during and after COVID, we have these nominal changes in value across everything from housing to energy to milk and eggs at the grocery store. And those nominal changes hurt as wages have not been able to keep pace. Looking at the interest rate environment, the federal funds rate has increased to 5.33%. It's been at that level for quite some time. We think we're at the peak of where that federal funds rate will be. Obviously, it was at 4.57% a year ago, and we've been at this 5.33 level for a while. The chairman of the Federal Reserve, Powell, that's his face there on the right, he has indicated that we should experience a few rate cuts later this year, but we don't quite have the metrics to support those cuts just yet, as noted by the high GDP growth and inflation rate. One other stubbornly positive element of our economy has been the unemployment rate. It is up a little bit. It's at 3.9% now versus 3.6% a year ago. But even with that, we're at a incredibly low number. We're about 50% below that what we consider to be normal unemployment rate of 6%. Sorry, a third lower than that. And we're at our longest stretch under 4% unemployment since the 1960s. So we'll get into some of the elements driving that low unemployment rate as well. And then employment growth, although down 32% from where we were a year ago, we're still adding 3 million jobs on an annual basis, which is one of the highest figures of the past 20 years. Looking at the M1 money supply, that's the money in circulation, actual physical dollars in your checking account and in your wallet. That number has actually come down a little bit to 17.9 trillion from where we were a year ago at almost 19 trillion. The problem is before COVID, the M1 money supply was only 4 trillion. So we have pumped a ton of money into this economy. That also has not helped the inflation rate, being able to slow that down. We'll get into that in a little more detail as well. And then looking at it from the commercial real estate perspective, we're going to look at two of the indexes here that drive fixed and floating rate commercial real estate debt. So the 5-year Treasury is what most banks and lending institutions use as the baseline index for their interest rates on commercial real estate loans. That's at 4.22% today, up from 3.67. It is down from the peak in October of 2023, which was almost 5%. And generally, lenders will put a spread of anywhere from 175 to 350 basis points on top of that interest rate to give you an actual interest rate that you're borrowing on. And then the SOFR, which is the index we use for most floating rate debt, and that's usually for bridge type or construction loans, and some people use it as a form of permanent debt, especially in this environment where they think those rates will come down over time. That those variable floating rate debt is that SOFR rate is at 5.32, also up about 15% from where we were a year ago, and that is at an all-time high right now. Moving into a couple of greater detail on some of these metrics. So you can see here, I note that the Fed's mission shifts from 555 to 245. And what that means is, we actually we're fortunate enough to have a meeting with the Federal Reserve not too long ago. And they spoke to us about, look, we need to get inflation under 5%. We need to get the federal funds rate above 5%, and we need to get unemployment above 5%. And that's been difficult to do. They've been able to hit it on the inflation side of things, getting it under 5%, and they've obviously put the federal funds rate above 5%. But the unemployment rate has been stubbornly low. You can see we're still under 4%. And so now they've changed that general guidance to, we want to get the inflation rate to under 2% now. We want to get that federal funds rate above 5% and stay there. And then that last part of the equation is, can we get the unemployment rate up to above 4%? I think they realize, as I will go into detail here, there is just too much of a shortage in the labor force right now to be able to boost that, even as economies are growing right now, to be able to have any meaningful control over getting that above 5% was a bit of a pipe dream. So they've lowered that target to 4%. And this is what I'm talking about when it comes to that labor force, that supply being constrained. And it's really a demographic issue we're dealing with here. We have the boomer generation, the baby boomers leaving the workforce now, and they were the largest, most populous generation, especially as it related to the workforce. And now as they reach the retirement age and exit that workforce, there's not enough people to replace them in the workforce. The total number of births in the other generations were lower. And so we're having a hard time not only keeping pace with what the workforce looked like under the boomers, but obviously we're trying to grow our economy at the same time. And so overall, this has given employees a ton of leverage in a variety of ways. So they've been able to push wages more aggressively. They've got better benefits. You can obviously see, if you look at the way that work from home and hybrid scheduling is working, a lot of employers are reticent to be too aggressive on getting people back to the office because they don't want to lose those employees. They're hard to replace right now. I will say, going forward, I think a lot of economists and labor specialists will tell you that if the economy does start to slow down, the leverage those employees have is going to be less, obviously, because the supply-demand imbalance will no longer be out of whack. We also are looking at the impact of AI on the total amount of labor force demand versus supply, and how that may have an additional impact going forward, where we could get back to that normal unemployment rate of 6%, but it's not going to be done by the Fed tweaking interest rates in an expeditious manner. It's going to happen more organically through other measures that are occurring in society today. Just a quick snippet here on the money supply. And so I mentioned before what the M1 money supply was. That's your currency in circulations, your checking accounts, your savings accounts, and then That's in blue. And then if you look on red, that's the M2 money supply. So that includes all of the M1 money supply plus money market accounts, CD accounts, and other time deposits. And so you can see that hockey puck spike during COVID when the government just printed a ridiculous amount of money, and that infusion of currency went to all walks of life: big corporations, small business owners, individuals. And so you saw this huge surge in that money supply, and you had a lot of people who were not drastically impacted by COVID, but all of a sudden were flush with cash from government money. And that is a big factor on where inflation went so high in that post-COVID environment. Obviously, we were suppressing the supply chain quite a bit because COVID disrupted a lot of manufacturing and importing of goods, combined with extremely low interest rates, a surge in demand, and people being flush with cash. And so now we're seeing it start to taper back down, but the damage here has already been done. We've pumped so much money into this economy. It's going to take a long time to work through and kind of normalize that money supply into today's environment. Looking at the economic growth across the country, this is the gross state product, which is essentially like the gross domestic product of the US, but I'm showing you the growth that occurred from 2022 to 2023 on a state by state basis. And I think this is important to note because a lot is made about migration, moving from state to state. Certain states have pro-business practices versus others. But if you look at this map, the growth is pretty ubiquitous. Yes, there are certain states that are doing better than others, but really, other than a couple states that you can see highlighted in white here, um, California's gotten absolutely slammed for some of their anti-business practices. But to Governor Newsom's credit, that economy has continued to hum along. Um, Obviously, there's been tremendous growth in Texas and Florida, as you might imagine, but there's also been growth in the Midwest, which a lot of people have written off as not having the growth prospects of other states. But there's some very solid numbers. In fact, the highest number is there in the Midwest. So important to note as you look for opportunities going forward that there is a lot of opportunity in a lot of states. It doesn't have to be your home state. I always tell people that opportunity doesn't have borders. So keep that in mind as you're looking at new opportunities in the real estate world, that there's a lot of metro areas, a lot of states that are having a tremendous amount of success and the economies are moving in the right direction. So you're not limited to maybe the metro area or state that you live in. One other thing to note, part of the fallout of pumping all that money into supply and what I would consider to be a bit of reckless spending from a lot of those consumers. This is the personal savings rate as a percentage of income. And this goes all the way back to before 1960. And you can see we, unfortunately, in society, we're not great savers and we're getting worse. And you could see up until the Great Recession in 2008, 2009, we were sliding down. We were not saving money for a rainy day. Um, People got hurt pretty bad during the recession, and those saving rates started ticking back up, and um, and then really spiked during COVID. And now with a lot of people flush with cash from a lot of government intervention, the spending got very aggressive. The savings started getting depleted, and now we are trending downward again. And this is a dangerous situation where now we've had nominal changes in the price of things to levels that don't support an ordinary income. So as we move through those savings, a lot of families, millions of households are going to be in real trouble on just ordinary cost of living. Healthcare and education as a percentage of income are higher than they've ever been. And those costs are somewhat fixed for some of the lower income families. So it's hard to move away from that. Obviously, you need healthcare, you need education, you need food, and those things making up a bigger composition of income It's a real challenge for a lot of households. And so what you're seeing now is a decrease in the savings rate as well as an increase in credit card debt. And I think that's something to pay attention to when we look at the strain on the everyday consumer going forward, especially in this elevated interest rate environment. So getting into the commercial real estate world, we're going to move through this relatively quick, but just want to highlight a few things for you guys. Number one is the commercial real estate volume overall. We're down about 80% from the peak in 2021. Most institutional investors and intelligent investors in general aren't going to buy properties at cap rates that cost more, or the cap rate is lower than the cost to borrow. So if you're buying something at a cap rate of, you know, let's say 5 and you have to borrow at 6, well, we consider that to be non-accretive. And so in most institutional investors are not going to play in that unless they see some kind of a larger macro trend where they think the market will rebound significantly. But if you look here to the right, you can see that the cap rates have expanded significantly over the last couple of years, not quite as much as you would expect with interest rates as high as they are, but that's because deals aren't being done. If you looked at where most people would want to transact today and get us to a normal level of investment volume, you would see those cap rates blow out by another 100 to 250 basis points, depending on the asset class. And so below that, I highlighted for each of the property sectors as well, where those interest rates stand today. So if multifamily deals are trading in the low 5% cap rate and uh, it costs 6% to borrow, there's not a lot of folks there. So as more and more deals get done, though, with this new pricing, we're seeing those cap rates inch up. And each time they inch up, they set a new floor in the market. And so we think over the next couple of years, you're going to continue to see some pretty good opportunities as sellers that have to sell are going to, help set a new low bar for a lot of properties on a price per square foot basis. And you're going to have this cap rate expansion where we actually can acquire deals on with positive leverage. CRE lending is tough, not only because of the interest rates, but because lending standards are now extremely stringent. So you have lenders not only charging a higher interest rate, but now they're giving you less. They're giving you lower loan to value, higher origination fees, more prepayment penalties, more recourse than non-recourse deals. And because of that, the lending momentum index, that's the chart on the left, has pretty much bottomed out as low as it's been in the last several years, other than a brief period during COVID when kind of lending shut down in general. And so the chart on the right shows you the impact of those interest rates, where they have gone. And basically, it's looking at the 5-year Treasury, which I mentioned earlier was the base index for permanent commercial real estate financing for most loans. You can see that minimum spread and maximum spread that lenders are charging above that, meaning the effective interest rates are anywhere from 6 to 8%. Makes it very hard to make a deal pencil when interest rates are that high and prices have not adjusted to that in a quick enough manner, which is why, again, we have that lower investment volume. One of the big opportunities coming up, and it's unfortunately a part of distress right now, is that banks are the largest lenders of the commercial real estate world, with 52% of loan.
Please try again.
Pardon me. The banks are now 52% of lenders of loan volume since 2019. And that's important because right now we're seeing those loans are maturing in 2024. And so you probably have read about First Republic Bank and Silicon Valley Bank and Signature Bank in New York. Well, there's a lot of other regional and even national banks that have lent out what I would consider to be risky commercial real estate loans, and they're dealing with that fallout now. And so if you look at this chart on the right, it shows what those maturities are. Well, there's nearly $1.5 trillion of commercial real estate loan maturities occurring over the next 3 years. And it's actually bigger than that, because even if we look at 2023, where you can see that there's over 400 million of those loans maturing, more than half of those were not paid off. That means the lender agreed with their borrower to extend and hope that things get a little bit better. And unfortunately, the market cannot move fast enough to fix the damage that's been done on a lot of those loans. So you'll probably see you're already seeing an increase in the delinquency rates because some of these banks have to realize um, what position they're in. But if you look in reality where the mark to market is on a lot of those loans, they are upside down at best, with a potential for not a lot of recovery value, depending on what type of property it is and what market it's in. But we think there's going to be some significant pain when it comes to the commercial real estate loan maturity world. And as that takes hold more and more, it helps speed up the new pricing in the current environment. It's more reflective of how deals can get done today. So with that, what are some of the challenges and opportunities in 2024? And I just want to highlight a couple things here for you as an investor that probably invests in a variety of things, real estate and non-real estate related. The first thing I want to share, and I'm sure like everyone here listening, I have money in the stock market. I have had for 2+ decades. Um, it's a little bubbly. Uh, it's been great to have this run, especially when you probably weren't anticipating it. But if you look at the historical 10-year PE ratio, we're at 33.7. That is 66% above what the modern era market average is, and suggests that we're pretty overvalued right now. A lot of economists uh, and investment managers are starting to sound the alarm saying, hey, this is going to be a hard number to hold up to, let alone grow from. And so you're starting to see some sell-off in the market starting to occur on a very low level. How much longer we can sustain this, I don't know, but it's certainly something to keep aware of, and gives you a little bit of pause to double down on your stock portfolio and possibly diversify into other investment opportunities. And looking at some of those other investment opportunities in the real estate world, I'm just going real quickly through each of the property types, and you can kind of see where there's opportunity today and where there's maybe some struggling. Looking at the multifamily and single family world, as I mentioned before, those cap rates are lower than the cost of debt. So you don't have accretive debt, and you're producing very low cash on cash returns. And there's a lot of operators, a lot of investment managers out there saying, well, housing's under supply, so we're going to have this massive rent growth. Well, we just went through a massive rent growth, and it has sucked the life out of most renters, where they are now giving a higher percentage of their income to rent than they ever had. Um, I don't think there's much more to give from that renter's perspective. So it's very unlikely that you're going to see another big run in rent growth, which means how exactly are you generating value in these investments? It's not from the cash on cash perspective. It's really going to be from a compression of cap rates if interest rates decline later a phenomenal degree, which most economists would agree that's a tough pill to swallow. So we're not huge on the multifamily, single family opportunity. The macro fundamentals are great. We're short on housing, but unfortunately, there's only so much blood you can get from a turnip, and if you look right now, it's just a tough pill to swallow. Being someone that's trying to make a dollar on housing for what has already occurred, other than the home builders. Industrial has a very similar flavor to multifamily in the sense that the cap rates are generally lower than the cost of the debt. The difference there is we are undersupplied pretty dramatically, especially in the core markets. And so there's a big runway to continue to boost rents there, because industrial rents, although they have grown pretty dramatically, as these e-commerce businesses and the need for third-party logistics grows, there's a little bit more room for rent growth in a lot of these markets. The biggest issue there is on the oversupply of secondary and tertiary markets. I get a little nervous when I see that there's 5 million new square feet of industrial and a tertiary market I've never heard of. Developers don't talk to each other, and that causes oversupply issues. And when it's not in a core market like Southern California or Dallas, or Denver or Phoenix or Miami, it gets a little it gets a little sketchy that we may not be able to keep up that growth in all parts of the country. Hotel is a tale of two stories. If you're in a high tourism corridor, you've been able to jack up your hotel rents, and the numbers have been phenomenal for a lot of hotel operators. If you're in the secondary, tertiary markets, business-focused travel, select and limited service hotels, they've struggled to a much greater degree, not quite rebounding from COVID the way some of the tourism and vacation-focused properties have. Retail actually, you know, they actually got beat up before COVID happened. 2016, 2017 was when retail really started getting beat up. COVID did not help at all, but now they're really starting to rebound there. So we're seeing some select opportunities in the retail sector where you can actually go put accretive debt on it and generate a decent cash on cash. And then lastly, office, which is a big part of Sentinel Opportunity Fund One. Um, that market has price corrected more significantly than all the other ones already. And because of that, you're able to buy properties at much higher cap rate ranges, put accretive debt on them, and generate cash on cash returns that are double opportunities on the other side of things. And when you factor in that fundamentals are improving and you can acquire properties with long-term leases in them, well, I'll get into this in a little bit, but you're getting a little bit of having your cake and eating it too, especially if you are able to buy something with long-term duration and put fixed rate debt on it where you have a very reliable coupon you can clip and know you're buying that property at the right basis. So not all office is good by any stretch. In fact, some of millions upon millions of square feet are going to be impaired forever. But the baby has been thrown out with the bathwater when it comes to the office sector. There's a lot of high utility, high value properties that have been discounted heavily because so much money has moved away from office in general. So we think there's a lot of opportunity in that sector for the next couple of years. Uh, so going into our Sentinel Opportunity Fund One, we're going to tell you a little bit about how we're going to take advantage of some of the current conditions in the market to succeed. And so, quickly, just as a disclaimer, this is only for informational purposes. Please don't reproduce this, and this is not an offer or an invitation to subscribe or purchase an interest in the company, and it doesn't constitute any investment advice. So my partner Fred Lewis and I created Sentinel in 2019. We've grown the portfolio of the company pretty rapidly. We've got just under 300 million under management. We have that nearly 1.9 million square feet across 12 states. We have a very user-friendly investor portal. We think transparency and clarity and communication is just paramount to any successful relationship between an investor and the management teams they work with. Luckily, several groups in our industry agree with us, and we've won a bunch of awards for our platform. And then really looking at, putting our money where our mouth is, we've been able to produce. And so since inception, we've created an average cash on cash return of almost 12% across all of our deals. And that's just on lease income. When we actually decide to sell a property, it's been even better. And we've been able to generate an average net IRR that's net to our investors of 36% on the deals that we've completed. So pretty phenomenal numbers there. We're very proud of what we've grown, and we think our investors enjoy the experience that we've been able to provide. For Opportunity Fund One, it's really simple. I'm going to walk through each of these in about 30 seconds. The market opportunity is great. We've got high interest rates that have now started to push pricing down, expand cap rates, and give us an opportunity to buy what we think are historically advantageous risk-adjusted return properties. Our approach is pretty simple. We only buy long-term, stabilized, cash flowing office, industrial, and retail properties using accretive debt. So we're focusing on basis, buying these properties at the right basis, and then making sure that it's generating enough cash flow so that the vast majority of that invested capital is coming back from contractual lease income at a minimum. Obviously, I've talked about how we're an experienced sponsor. We've operated in a dozen states. We've got, between myself and the two other executives on the team, we've got 75 years of experience working in institutional investments across the three of us. And then also important, I think, for funds, any fund you're going to consider is looking at how are they going to actually execute on this business plan? What does the pipeline look like? How do they source properties? I'll get into that very briefly, talking about what our pipeline looks like for the fund. Unlike a lot of other funds, we're actually doing the first closing with 3 properties under contract and soon to be 4. So you have a good idea about what we're buying. We're very thematic in what we're trying to do. As you can see here, as we walk into a little bit about the fund's investment strategy. And as the market has changed over the last couple of years, our investment strategies changed slightly. We're still buying the same type of high quality um, Class A and B plus assets, but now we're able to buy them at higher cap rates. Unfortunately, the interest rate is higher. There's not anything we can do about that, and we borrow with less leverage. Another function of the lending environment. But what's really exceptional here is we're able to acquire with a longer lease term. So you can see there's a average WALT. That's a weighted average lease term. So before we were buying deals that had 4 to 7 years of lease term remaining. Now that number is 8 to 15 years. So you have a lot of lease term remaining, which is having that type of security, knowing that your tenants aren't going anywhere. Gives you a nice ability to know you're going to clip a very strong coupon. And equally as important is we're buying at a better basis. So because those cap rates have gone down um, on the same properties, or excuse me, those cap rates have gone higher, the price per square foot has gone down. So now we are acquiring for anywhere from 25 to 40% less than what we acquired just a few years ago with that longer lease duration in tow. So our cash on cash return in year one has gone down a little bit. But if you look at the overall amount of capital that's projected to be returned from lease income, it has more than doubled in most instances. And when you're buying at a high cap rate and a low basis, it doesn't take a lot to move the needle to generate an overall IRR when you sell the property that's comparable to what we were doing in the past. So to summarize, it's pretty simple. We're buying at a higher cap rate, a lower price per square foot with more lease duration, and that's giving us an overall more attractive risk-adjusted return within Sentinel Opportunity Fund 1 than what we've done in the past. Some elements of the fund term itself. What are the benefits of investing in a fund than maybe one-off deals you've done in the past? The economics of it are very similar, but really some of the most natural benefits you have in an investor is number one, you've got investment diversification, not only across product types, but across geographies. You also have access to larger deals and a competitive advantage as a fund operator versus a traditional syndicator doing one-off deals. By us having a $100 million fund, which is the target for Sentinel Opportunity Fund 1, we can chase some of the larger institutional caliber deals that most syndicators can't. Sitting on a war chest of cash allows us to not be reliant on debt. And being a fund gives you just a certain amount of heft that gives the sellers a comfort that there's certainty of execution in what you're doing. And that's a huge thing in this environment right now, where the debt markets are all over the place. People have difficulty raising money on a deal by deal basis. By starting this in the fund and having the combined efforts of hundreds of investors in our deals, we're able to go chase those bigger deals and show to the sellers, hey, we have the ability to close on these when a lot of others don't. And that gives us a competitive advantage to not only win the deals, but win the deals with not necessarily the highest price. And that's what's occurred on several of our deals already. So we're pretty excited about the advantage that brings to our investors. There's also the simplified tax reporting elements. In the fund, there's just one simple form, K1. And then we also use accelerated depreciation. We do perform a cost segregation study to accelerate that depreciation. A ton of it moves to the first year or first couple years, depending on the property type. But that's a huge benefit for those you investors looking to offset other income from other investments. Because even though we could be producing a strong cash on cash return, it's going to show us a loss in the first year because of that accelerated depreciation. And lastly is the alignment of interest. As as investment managers, we invest into every deal that we do at Sentinel. There are a lot of fund managers that don't actually invest in their own fund, but my partner and I are committed to our strategy. We think it's got great scalability. We like the thematic nature of it, and so we're investing $5 million of our own capital in the $100 million fund. So we're aligned with you. And then we've also structured this deal to have the fund to have a European waterfall. And what that means is basically, as the fund managers, we are taking a back seat on our returns. So all of our investors need to get all of their money back, all of the preferred rate of return, but on the entire deal before we start to participate in the promote in the upside on the fund. So we're really waiting to the last couple deals sell to get our portion of the profits. A couple of other elements of the terms of the fund, just so you know, the minimum investment is $100,000. It's for accredited investors only. We have an 18-month fundraising period that starts in April 2024. We have 3 years to acquire properties, and then we have 7 years to manage that fund. Now, we have a couple extension options because as investment managers, we don't want to sell. We don't want to be forced to sell at the wrong time. So if we do need to extend, we will, because we don't want to be one of those sellers that has a gun to their head and has to sell at the wrong time in a high interest rate environment. Nobody wins in that situation. So there's a little bit of flexibility at the end of the fund to make sure that we're not selling at the wrong time, solely to the benefit of our investors. And then I've already talked a little bit about what our targets are, but we're targeting an 8 to 11% cash on cash return in year one. It gets better over time as we get rent appreciation, contractual rent increases that will continue to boost that. Our target net IRR overall is 16 to 20%. Historically, that's more in line with a value add or even a development strategy. But we think we're buying at the right basis with the right duration, that we can generate that very realistically without having to take any of that construction or lease up risk. We offer an 8% or 8.5% preferred rate of return, depending on what class of investor you are. I've already mentioned the European waterfall. And then from a leverage standpoint, so you understand what we're doing, we'll take property level financing that's generally 50 to 65% of the value, and we'll go get a loan on that amount. We will distribute proceeds quarterly to our investors via ACH. And then we're not redeploying any of the capital here. So if we sell a deal in 2 or 3 years, whenever it is, that those investment dollars are going back to you. This isn't an open-ended fund. It's closed-end. We think we have a very unique window here of 2 to 3 years to go buy properties at a very compelling price. And then when we sell those properties, that money's going back to you. And then, as I mentioned before, from a tax benefit side of things, we'll use cost segregation whenever applicable to take advantage of that accelerated depreciation. Really quick on the investment criteria, I've already told you what kind of properties we're buying and what we expect those returns to be, as well as we're financing them. But just a couple things to hang our hat on here as well is, we're really focused on suburban properties. So we're not big believers that there's a quick bounce back to the downtowns pretty much anywhere in this country. They've got so many things working against them that we think you have to have a historically long-term view on downtowns coming back, whereas suburbans are now the new downtowns in a certain sense of the manner. It's where the nice restaurants are. It's where the best gyms are. It's where the best hospitals are. It's that those returns of commercial services and quality of life are in those suburban locations. So that's where we want to focus on. Generally focused in the top 150 metro areas in the US, and looking for places that have good, strong existing demographics and/or are poised for significant growth going forward. We're generally looking for Class A and B properties that have little, if any, deferred maintenance. We really want something in tip-top shape. And then looking at the tenant and lease criteria, obviously our name is Sentinel Net Lease. We like net leases where the responsibility is generally on the tenant to keep up the property, to pay property taxes. We don't want to absorb those operating costs whenever possible. And for the type of tenant themselves, we love big companies. So in our existing portfolio, it's Amazon and JP Morgan and Tesla and AT&T and United Healthcare, all kinds of big Fortune 500 companies. That's generally our target. We'll take on non-investment grade rated, credit rated companies, even privately held companies that aren't credit rated, as long as we can really understand and digest their financials, to understand what that default risk is like. Because obviously we don't want to buy a property with the potential for them to vacate the property, default on the lease. So we've really got to be dialed into understanding their financials and their ability to pay rent as scheduled. And most of our buildings are single tenant. So generally it's going to be that one tenant that's occupying the entire building. We have a handful of buildings that are more than one or two tenants, but generally that's our primary strategy. And as I mentioned before, we're looking for these long-term leases, 8+ years of lease term remaining, with annual rent increases also a part of it. And then also looking at the physical occupancy of the building. We want to know and make sure that they are using this building today, and what their plan to return to work is if they're not using it in mass. In the vast majority of our buildings, they do have strong daily utility. It may not be Monday through Friday, but it's at least 3 days out of the week, and with management having an eye on an even higher physical occupancy as they can get away with it. And really looking for those sticky tenants that have a high utility and a high need. Why is this a mission critical building to them? We own a lot of corporate headquarters um, that are obviously very important to the companies that are leasing them. So we think those are a lot stickier than just a random law office, a regional hub. Call centers are a little less important now than they were in the past. So we're really looking at that mission critical nature of the building to the company that is occupying it. As I spoke previously about our active pipeline, we're starting this fund out with 3 deals under contract. And so to show you the kind of deals we're acquiring, we're having an office headquarters of a company called Juice Plus. They're a $400 million a year nutritional supplement company that's in the Memphis market. We're buying that property for almost $8 million. And what's nice about that is it's a 20-year lease. It's a sale leaseback. We're actually acquiring it from the company, and we're acquiring it with a 10% cap rate in year one. So that has a very strong cash on cash profile from the very beginning, and a tremendous amount of duration. We're buying that property at a fraction of replacement cost. And then complementing that is 2 fitness centers that are owned by Fitness International. That's the parent of LA Fitness. They're a B-rated company through Moody's, in 2 good markets, Columbus, Ohio, and Charlotte, North Carolina. Buying those combined for about $16 million, and a cap rate of almost 9% with 10 years of lease term remaining. If you go look on the market right now and you're trying to find an LA Fitness with that level of term, you would expect to pay maybe a 7 to a 7.25% cap rate. So we've got some arbitrage created on those on day one. So we're pretty excited about those. And then you can see below this, we have another half dozen properties that we're bidding on actively right now. We actually just got verbal confirmation on one of these properties that is shown here. It's a office headquarters that's 18 million and 11% cap rate for 11 years. It's in one of the better Texas markets. We're very excited about that as well. So we're going to continue to add these properties that create very strong cash flow and are contractual for very long periods of time. This is not the time to speculate on whether an investment can make money or not. There's a lot of multifamily operators, a lot of industrial operators, and their entire basis is they're going to be able to jack up rents and create something that is just not in their control. It's outside of what they're doing. They can't control where interest rates are going. And so if interest rates don't come down, what do those returns look like for those type of opportunities? They're not great. Certainly probably lower than what you can get in your high yield checking account. Whereas what we're doing is significantly higher than that, and it's got the duration to give you comfort to know that if the market does move in that direction, that all the other operators think we're going to hit the returns out of the park compared to operators like that. And if it doesn't, we're still trading a cash on cash return that is significantly higher than opportunities in other asset classes. So interested in investing with Sentinel in the fund, how does it work? What is the process? So first of all, as I said, it's limited to accredited investors. So if you're not an accredited investor, I'm sorry, you're not eligible. It's a 506C offering. Um, and it's pretty straightforward what the process is like. It starts with the indication of interest form. That's basically just a soft, non-binding reservation that holds your place in the fund. Then we do a third-party verification to ensure you're an accredited investor. Then you get all the documents. That's the subscription documents, the offering memorandum, the operating agreement. You review all that. It's all done via DocuSign. And once that's all completed, you wire the funds into the fund's operating account. And there we go. The first closing, as it set for right now, is in late May of 2024. And I think what you'll find here, if you haven't invested with Sentinel before, is we offer a best-in-class investor portal. Our investment management software is truly elite. It gives you total transparency. You can see anything you want about your investment at any time. You download your tax documents from there. We communicate with you via email and text. We're always available for phone calls, but you always have that sense of peace that that whatever information you need is just on your at your fingertips by logging in. So that's always nice. And with that, that's the end of the presentation, I think. Oh, we've got one more thing. I'm sorry, I forgot about this. So for our founding LP investors, we're actually offering a special incentive. We are offering lower fees. You'll see lower acquisition fees, lower fund management fees, lower disposition fees for those investors who commit capital by the first closing in late May. In addition, you're getting two other really cool benefits. Number one is a lower sidecar eligibility investment. And so for those of you that don't know what sidecar investing is, it allows you to weight your investment on specific deals that maybe you like that we're doing, that we're in the fund. So if you invest at least $250,000 into the fund, you'll have the eligibility to invest additional amounts into specific investments, specific properties within the fund. So you would be overweight on those specific properties that you like the most within the fund by being eligible for sidecar investments and investing through that sidecar. And then lastly, you get the full benefit of accelerated depreciation via cost segregation. So and that's included on the first few deals we're buying. Whereas investors that come in later won't be able to go and recapture that accelerated depreciation on the first few assets. So you'll be a little overweight and get additional accelerated depreciation, assuming we don't raise all $100 million by, the end of May. So really nice feature there as well. Okay, and so with that, there's really a pretty specific call of action that I would encourage all of you to take. Number one, use your phone and scan this QR code to download our fund investment summary. This is a very detailed document, still very readable, but will give you all of the nuts and bolts about our fund strategy, the terms, and really help you digest what I talked about a little bit today in much greater detail. And then secondly is you can scan the QR code at the bottom, which is the indication of interest form. And that's, if you're ready to invest, scan that, you'll be able to reserve your place in the fund. And then lastly, I put our head of investor relations, Laura Wynn's contact information on there. If you have any questions about Sentinel, the opportunity fund, our processes, our management team, our history, whatever you'd like, she's happy to walk you through all of it. We do one-on-one meetings with her all the time for new investors. I'm also available to meet with new investors if they'd like more color on our investment strategy and where we're headed. And with that, I say thank you. I appreciate the time you've taken today to learn a little bit more about the market as well as Sentinel Opportunity Fund 1. Thanks so much. Have a great day.